Hello and welcome, everybody. Mike, what are we going to be talking about on today's coaching call?
Hey Rob, so today what we're going to focus on is how I was able to buy over $2 million more of real estate this month alone, leveraging creative financing as well as raising the capital for all of my entry costs. So not just the short-term rental side, but the capital raising side, how we leverage private money lenders and private money partners to acquire some great deals. All of them are short-term rentals or have short-term rentals in them, and they're all creatively financed. So we'll kind of high-level overview each deal, kind of the way it was structured, and then the way we were able to raise capital and kind of what that looks like so that maybe you guys can do the same instead of exclusively using your own money.
No big deal. Just close on $2 million of real estate in the last 30 days. Well, I love it. That's a great agenda. Let's do it. Take it away, sir. We are here to
Awesome.
learn.
So guys, we're going to go over three deals. The three deals I want to talk about today. One of them is, oh, maybe I should screen share. Maybe I'll screen share my calculator for you. I'll just so you have something fun to look at.
Yeah, I gave you share access, so you should be good.
Perfecto. Actually, okay, so here is the creative finance calculator that I use to analyze all of my deals, and we'll go over it real quickly at a high level, just showing you the calculator, and then we're going to actually go into showing some of these deals and then how I effectively and efficiently raise capital for these deals and articulate is this an opportunity that would work with a private money lender and a private money partner? And I'll kind of explain what those are. So actually, let's start with that first. Are you guys familiar with what a private money lender is? What does a private money lender do? And kind of how do they're both ways to get capital to buy deals, but like, how do you work with a private money lender? Has anyone ever worked with a private money lender?
No.
No one has?
No.
Awesome, no worries. All right, cool. Well, let's go into it. So there's two real ways. Well, there's multiple ways to raise capital to buy and hold real estate. But my business model is buying and holding real estate, right? And I use other people's money to buy real estate. At the same time, I use all of my money to lend to other investors, whether as a private money lender or a private money partner. A private money lender is someone who has capital that they invest in your deal, and they are getting a fixed interest rate return over a fixed period of time. For example, a private money lender quite often will get 12% interest rate return over a 1-year period. So they lend you $100,000 for 12 months at 12% interest, which means they're going to get 12% return on their money that year, or $12,000, right? And the amount that you pay them interest only until that 1 year is up, and then you balloon. That gets ballooned. You owe them their principal back. Sometimes you can pay the interest monthly to them, so $1,000 a month, right? $12,000 of interest divided by 12 months, $1,000 a month, or quarterly, right? So $3,000 of interest per quarter, or all of it gets paid at the balloon date. So at that 12-month mark, you'll pay them their $100,000 back and 12%, their 12% interest, or the $12,000 of interest. So a private money lender is typically doing that type of lending to get a solid return on their money. And for my buy and hold investing, the way I evaluate it is, does my monthly cash flow generate enough income each month? Do I generate enough income each month to pay back my private money lender their interest on their money? And then when the balloon comes, you have various ways to address that. Like, let's say the $100,000 they gave you to invest. More often than not, you are not going to generate enough cash flow to pay back their $100,000 of principal in 1 year. When you're used to fix and flippers doing this, the reason why it works is because they're buying a property for $500,000. They're going to add $200,000 of renovation, carrying costs, whatever, and the property's going to sell for $1 million. Once they get their $200,000-$300,000 at the sale, they'll use that money to pay back their lender, right? With a buy and hold, that doesn't really occur in that way. There's various ways to address how you pay back your private money lender. However, they're a little different. So the most common one that we use is, once the balloon comes, we're always raising capital. So we just refinance that private money lender with another private money lender. We could refinance the property, but I'm buying properties at 0% interest rates, 1%, 2%, 3%, 4% interest rates. I don't want to refinance that property and lose that great interest rate. So instead of refinancing the whole property, I'm essentially just refinancing that private money lender with someone else. Usually you can get the same interest rate for the same amount. So if I have $100,000 for 1 year, in 1 year, I'm going to find someone else who wants $100,000 in 1 year, right? And then we'll just recreate that same loan. Or typically I'll have enough cash flow generated that I can pay back some of that principal, maybe not the 100,000, but I can pay $5,000 to $100,000 of that off. So, or $5,000 to $10,000 of that off. So the next time I raise capital, it'll only be for 90,000 because I'll be paying $10,000 of that through the cash flow that I've generated. That's one way, is to refinance them. And actually, more often than not, the next time you go to refinance one private money lender with another, typically you can actually offer a lower interest rate return because you've proven that this property performs. You've already paid someone else return on their money. So you're proving that this is a more stabilized asset at this point because it's less risk. There's also slightly less reward for the lender. But worst case scenario, you find someone at the same interest rate and you just continue extending it. Other ways you can pay it off, like I said, you could refinance or sell the property if you have the equity. It's not really ideal, especially for these short-term loans. We have additional income streams. We wholesale some deals. We joint venture. We do a variety of other things that generate income we can use to pay off the loan, although I don't necessarily like to do that. Or when it's time to balloon, like to pay back that private money lender, you can ask them if they themselves want to extend or if they want to convert to a private money partner. A private money partner is distinct from a private money lender. Private money lender lends you money for a fixed interest rate return over a fixed time period. Private money partner is lending you money, but they're not really lending. They're buying equity in your property. So let's say you have a property and you need to raise $100,000. Let's say in this instance, $66,000, $695 to acquire the property. Some money's going to the down payment, agent commissions, rehab, whatever. All these fees. So you need $66,695 to acquire the deal. And in this instance, well, let's make it cash flow more. It's going to cash flow as a long-term rental. Let's just increase this for this example. So in this instance, you're cash flowing $688 a month, right? Or $8,261 a year. Right? Oh. Sorry, Matt, I gotta mute you. So, in this instance, actually, we'll look at this as a private money lender and private money partner. So you need 66, let's just say 67,000. I'm going to add $5 somewhere because that'll make this a lot easier. Perfect. $66,700. You know what? Let's make it even easier. There you go. $67,000 is your total entry cost to acquire this deal between down payments to sellers, whatever, all your acquisition costs entirely. And your property is producing $688 a month of cash flow after you subtract away your expenses. In this instance, this is a hybrid deal. You have a purchase price of $240,000. You're giving the seller a $24,000 down payment, right? That's part of your entry cost here. You have a $188,000 loan that you are taking over subject to, and there's seller finance at $27,791. The remainder, right? The purchase price minus the down payment minus the loan you're taking over. The remainder is the seller's equity that they're allowing you to finance at 3% over 30 years. So part of your monthly expenses are your seller finance payment, your subject to payment. In this instance, as a long-term rental, you have property taxes and insurance as well. The utilities, all that stuff is covered by your tenant. Don't really worry too much about the numbers. We just want to talk about the concept overall. So your total entry cost is $67,000. Your income on this property, which I doubt that would happen, is $3,500 a month of income, $1,800 of expenses, $350 a month is property management, and $630 a month is set aside for reserves. So your net cash flow is $688 a month, right? So if you were the one to fund this $67,000, your cash on cash return would be 12.3%. That is a very solid cash on cash return. And I also like to see, what if I didn't need to save for reserves? What is my cash flow and cash on cash return? And in this instance, it's $1,300 without reserves and 23.6% cash on cash return without reserves. I like to know that because theoretically, utilizing your full reserves should be your worst case scenario. Could it get worse? For sure. But that should kind of be your worst case scenario. And you looking at the numbers between your, yep, go for it.
I have a question. So you said that, when you use your reserves, but what is sort of like the time period that you put on your reserves before you dip on them? Just from your personal philosophical standpoint. For me, I pretty much always have them, but I know that some people do dip into them. So is there kind of like a statute of limitations? Like if you don't eat into them in 2 years, it's kind of free cash flow, or what's your
Right.
philosophy there?
So what I do, especially when I'm buying property with using other people's capital, right? They're coming as a primary lender or primary partner. I'm raising reserves up front. In this instance, is 5,800. I tend to raise $10,000 to $15,000 per property up front, and then I set in my agreement what is the amount that I need. What's like my limit of reserves? Usually it'll be between $10,000 to $20,000. Once I have that much set aside for one property, the rest will just go out as cash flow. I don't underwrite that way, right? I don't underwrite that way, but that's the way my agreements are set, that I always underwrite that it will always be pulling reserves of 10% a month, 5%. Well, actually, yeah. So right here, 5% for maintenance, 5% for CapEx, or 10% total, and then 8% for vacancy for long-term rentals, which translates to 1 month a year the property's vacant. If it's a short-term rental, it's a little different, right? Because you have your occupancy, you have your average, it's a little different because you already have your occupancy. It's not really vacancy, but you still have your maintenance and CapEx. So for me, I set like a fixed dollar amount based on the value of the property and what I anticipate. But usually my most expensive properties, I really cap it out around 20,000. My lower cost properties, I say 10,000. Does that mean that I will never need more than that? For sure not. Because if you have to replace, your HVAC system or your roof or a lot of appliances or your flooring, it can easily eat away those reserves very quickly. However, my portfolio is fairly diversified, and the fact that I'm buying with partners, we'll both have to contribute towards the reserves or towards the repairs if there's not enough reserve set aside. So a lot of people I work with, we want our money back sooner, but we don't want to leave the property like in a very bad position if we need to tap into our reserves. So I set between 10 to 20,000 depending on the property. And then once that is full in a bank account and a savings account, then we'll distribute the remainder. Instead of saving 10% each month, we'll just collect that as cash flow and pay it out to the owners. Hopefully that answers that question a little bit. I don't really have a great rule of thumb. I know some people say like 0.5% is what I've heard equals 0.0005. Is that right? 0.5%? No. 0.05 times the purchase price. Well, maybe that's not right either. I don't know, whatever. So maybe that'd be like 12,000 for this property. I know people have like rules of thumb. I just do basically between 10 to 20,000. So someone asked a great question. Scott asked, where does a private money fall in the debt stack? Is it a recorded lien? So yes, private money lenders are recorded in this instance because there's a first position subject to loan and the seller is coming in and financing you. They are in second position. The private money lender would be recorded in third position. Very different than on a fix and flip when you are, the equity is the number one focus. You want, as the lender, you want to be in the highest position as possible. Whether you're funding it all in first position or you're coming in as a gap lender in second position, you want to make sure there is more than enough equity. If something were to go wrong and the bank had to take the property and they sold it, that you get your money back. That's where you're really focused on when you're lending on a fix and flip, we'll say. On a buy and hold, where it's really focused on cash flow, you want to make sure your security isn't really the position in which you're secured, because a lot of the times, by the time we buy this $240,000 property, that's probably worth close to $240,000 and have these entry costs and this private money lender note in there. It's already negative equity. So if you were to sell the property or lose the property, you would lose that equity. So it's really focused on, does the property generate sufficient cash flow to pay me back my interest? And do I trust the operator? Have they proven themselves as successful investors and operators to then be able to exit me out of my principal at that 1 year mark. Having equity in the property may or may not make the difference, but it probably won't unless their plan is to sell or cash out refinance to pay you back, which isn't really likely because we're buying these great 0, 1, 2, 3, 4% properties. So hopefully that makes sense. The security for a private money lender on these buy and holds is less on the equity of the property, more on does this property generate enough returns to pay me back as the lender, right? So that's how I would think about it with you. If you're raising capital, I mean, if you're deploying capital, also if you're raising capital, your main focus needs to be, can I comfortably pay back my lender their cash flow each month or their interest rate that they need to each month? And then do I have a plan in place for when I owe them that principal amount, that $100,000 or that $67,000? All right. So let's get back to this example real fast. So your income of $3,500 minus your expenses, management, reserves leaves you at $688 a month of cash flow, which is a 12.3% cash on cash return. If you have the $67,000, that could be a good use of your funds. I do have $67,000. However, as a rule, I don't use my own money to buy real estate. I use other people's money to buy real estate, so that money is never an obstacle for me to be able to buy great deals. And I can scale my portfolio based on the number of great deals I have, not how much money I've already deployed. At the same time, I lend my money out to other people, and I'm very happy with a 12% return in someone else's deal, or being a private money partner in someone else's deal where we share ownership, right? So as a private money lender, you're getting fixed interest rate return on your money over a set period of time. But as a private money partner, you are bringing in the capital to buy the deal, and that is buying you an equity stake into the property. That is going to get you, you're going to get ownership benefits, including cash flow, right? We're all familiar with cash flow. With, you're going to get well, let me just show you right here. You're going to get ownership benefits like, so this is my very easy way of raising capital, how it's all outlined, whether I can bring in a private money lender, let's say that 12%, 0%, 0 points. So in this instance, if you were to use a private money lender at $67,000, 12% interest, and a 12-month loan, you're going to pay them $670 a month. That's what you're going to pay your private money lender in interest. You only make, typically it's interest only payments to your private money lender. You're paying them down their interest. Sometimes you pay them, depending on how you structure it, monthly, quarterly, biannually, or all of it at the end. Really depends on your lender. As the one raising the capital, I prefer to make as few payments as possible until the very end, because then I can use that money and have for reserves and whatever. Gives you more flexibility, but it also depends on the lender that you're working with. So when you are to, if you were to pay them that amount, you would be left over with $18.46 of cash flow. So the cash flow you had at $688 now becomes $18.46 of cash flow, right after reserves and all that are accounted for. For me, that's perfect. If I can generate more cash flow than if I can generate more cash flow, if I can generate any positive cash flow after paying a lender, that is phenomenal for me, because my returns go from 12.3%, as long as I have the $67,000, 12.3% cash on cash, to infinite returns. So now I own in this asset and I'm getting the returns. The returns are infinite because I put none of my own money in there. And yes, this $18 of cash flow kind of sucks, right? But at the same time, it's not just $18 of cash flow that you're generating. For me, I don't need the cash flow as well. I reinvest my cash flow into my business. Very different for other people. But in this example, you're also setting aside $630 a month, right, to reserve. So your property is building reserves. You've already raised reserves, and you are also getting some of these other benefits. For example, in 1 year, you're paying down $5,000, $5,114 of principal. You're paying that down on the debt. Someone else, your tenants, are paying down the debt on your loan, and you're getting these benefits using none of your own money because a prime money lender funded the deal. So maybe you're only making $18 of cash flow, but you're getting $5,114 of debt paid down on your behalf between your tenant and your lender, right? That's what they're doing for you. You're getting the benefits of appreciation, tax benefits that come from interest payments and depreciation, depending on your tax bracket, if you're a real estate professional, all that good stuff. So you're getting all of these benefits plus $18 of cash flow, if that makes sense. And then in a year, when you refinance this 12% with a 10%, and let's say your cash flow that you generated is only $18, so you're not gonna have enough to pay down the principal. You're still gonna have the same $67,000 because that times 12, right, is barely any money at all. $221, right? It's insignificant. But let's say you use some of that $630 of reserves. So you take let's say you take $300 of that. So you have $3,600. The next time you need to refinance this prime money lender with another one, you're able to get 10%. So now you're generating $130 a month. And you were able to reduce the $67,000 by $3,600. So now you're making $160 a month, right? So it just continues progressing. And every year, not only are you increasing your cash flow with none of your own money, you're also getting all these benefits compounding, right? Your debt continues to pay itself down $5,000+ a year. And if you know amortization schedules, if you understand the way it works, the earlier in the loan, the more each monthly payment is going towards interest. The earlier in the loan, the more that goes towards interest versus principal. The longer you hold a loan, the more payments you make, more of that monthly payment is going towards principal versus interest. So this debt pay down gets better and better. The property appreciates, but it appreciates on its new value every year. So if it's worth $100,000 the first year, I'll actually have all that here. Let's see. If your property is worth $240,000 the first year and appreciates 3%, it's now worth $247,200, and then it compounds another 3%, right? Not of this value, but of this value. So now it's 254, and it continues increasing in value, right? It continues appreciating more and more each year because that's compounding benefits. Your debt pay down gets higher and higher because if you look at an amortization schedule, although your principal and interest payment, your monthly payment is $843.21 every single month, the portion of that that's going towards interest decreases each month, and the portion of that goes towards principal increases each month. So the longer you can hold an asset, if you have a longer term horizon on investing and are not just worried about your day one cash flow, you can end up buying an infinite amount of properties, as many as you can handle, right? And operate, and all your benefits continue improving and improving and improving over time, as well as your cash flow. Because not only is it that you are increasing the cash flow by paying down some of the principal and reducing the interest rate the next time you find a lender, primarily because you have more time this go around, right? You know, you've seen most closings are within 30 days with creative deals. A lot of them are within 2 weeks. So you have more time to find the lender, and you have a more stabilized asset at that point. Let's see. And then you get all those other benefits. So your cash flow continues to increase. And let's say this property is renting for $3,500 this year, even if it rents for $50 more a month, the next year, that's also increasing your cash flow. So the idea is if you can get into it may not maximize your cash flow, leveraging lenders, but your returns become infinite. So you're eating away in your cash flow, but your cash on cash return is infinite as long as your properties are performing positively. I saw a question for the refinance from 12 to 10%. How long do you normally wait to refinance? I do not like to refinance my lenders out of the deal until their loan is up. Because when someone lends to me for 12% for 1 year, they're looking forward to that full 12% for that year. So could I refinance them a few months early and save let's go back on these values. Could I save so it's 1846, or let's say 670. So it's 12% is 670, 10% is 5. Actually, that's pretty solid though. Whoops. So could you save $111.67 of monthly interest? For sure. And let's say you do it 6 months early. So now you've saved $670 of interest. My relationships with my lenders are way more important than the interest I can save. So I'd rather wait until the full amount, maintain that relationship with that lender, because as soon as I give them their money, they're going to want to redeploy with me again anyway. So I usually, right? Usually, okay. So let's see. So Scott, are there any kind of origination or other fees, or is it just interest? For my loans, there are not. The way I do it, I have origination fees. You can have origination fees. Some people want, I mean, I'll say this, the more proven you are as a buyer and operator of assets and a capital raiser, the better the rates you're going to get. At a certain point, it makes no more sense to optimize. I have some lenders that are 8, 9, 10, 11, 12%, whatever. I pretty much keep it 8, 10, 12 is what I focus on. And oh, what's up, sub 2 Drew? 8, 10, 12%. Instead of trying to like find every variance, every variation, like could I save 1%, whatever? Yes. But it's more important for me to make it more scalable, to make it more standardized. And as I showed you, the interest rate, yeah, you're going to save a couple $100 of interest, but it's way better to maintain that relationship with your lenders. Let's see. Sujita asked 2 questions. Where do we find private money lenders? That's a later question. And I mean, everyone theoretically with money is a private money lender if you can educate them into, or just offer them this investment opportunity, right? I mean, that's really what it is. I'm not saying, hey, give me your money, I want to use it for my own benefit. I'm saying, hey, I'm going to give you give me $6,000, $7,000. I'm going to give you 12% interest return on your money, which a lot of people are very happy with, double-digit returns on their money. But the less proven you are, the more risky the investment is with you, right? So you build your skill set, and that's where private money partnerships, especially starting out, is a great way to start with raising capital. And Sujita also asked, how do we pay back the principal? So Sujita, I don't know if you came in late or what, but we talked about this. You will almost rarely generate enough cash flow to pay back the principal of your loan through just cash flow in 1 year. Could you refinance or sell the property? Sure, but you probably don't even have the equity to do so and pay back your PML in 1 year. So what we do more often than not is refinance our PML with another PML at that balloon mark. And as I mentioned, usually when I'm refinancing that original PML with the next one, I'm actually able to offer less interest rate return because now we have a more stabilized and proven asset, which has already been paying another lender back over that last year. And I had more time to raise the capital for that new lender than the first go around. So I have more people, more people I could talk to and say, hey, 10%, here's what we've done over the last year. All we need the money for is XYZ things, whatever. You can also raise the capital. No, you can ask them if they want to extend. You can convert them to a private money partner. You can bring in a private money partner to replace them, similar to just the private money lender. You can use some of the reserves that you've been saving to pay back some of the principal when you refinance. You can use income streams that you have from elsewhere to pay back that PML. It's ultimately up to your call, but you're not really going to have enough equity in 1 year to then refinance them or sell the property to pay them back. It's very different than when you are raising capital for a fix and flip property. So let's get back into, so here's a private money lender, right? This is why, even if I'm making much less cash flow, we're going from personally making $688 a month and 12.3% cash on cash return. I would much rather always prefer to make that $18 of cash flow with a private money lender and get infinite returns. Okay. It's up to you what you want to do. If you got the money and you want to keep buying properties only using your own money, that's perfect. Unless you have a ton of money, an unlimited amount of money, you're limited into how many deals you can buy. And real estate cash flow is one of the benefits. There are the other benefits, and every benefit in real estate investing only gets better with time. So if you get more assets that build your portfolio to then just continue improving with time, then that's the goal. For example, I talked about cash flow is going to improve with time because your income is going to increase on the property. Sure, your expenses and all that will increase too. Typically, your income will outpace all that, especially because your debt is fixed, right? The loans that we talked about are fixed. The tax and insurance will go up, but the debt themselves are fixed. You get the debt payment, debt pay down, and every year, right? We talked about every year that debt pay down is better and better and better because more of your monthly payment is going towards the principal versus the interest. The property appreciates over time, and not only is it appreciating, it's not appreciating off the original $240,000 value, it's appreciating off its new value. So that continues to compound, and each year, this isn't 7,200 and now it's worth 7,400 on top of that. It's the first year appreciated 7,200, then it appreciates 7,400 the following year, then 7,600 the other year, because that's compounding on itself. So your appreciation's compounding, your debt payment pay down is improving with the amortization schedule. I mean, the tax benefits are kind of what they are. They actually get worse in a sense because one of the tax benefits is interest payments, and interest payments, if more of your monthly mortgage payments are going towards principal, means less is going towards interest, which, you know, you get less of a tax benefit from that, whatever, at least you're paying down more of your debt. And your depreciation benefits. I know a lot of you guys are probably doing 5-year accelerated depreciation, but you know, that's basically going to be fixed for most people for the next 27.5 years. So a lot of the benefits continue improving with time, even if your cash flow doesn't substantially increase, or you start off with little to no cash flow. I have this one that's for sale on my website. I think it's less than $500. It's very much worth it. I have a free calculator that I will drop in here. Let's see. Boom. So if you go on to my website, it's just michaelmnat.com. You can get the free calculator. I have a conventional finance and creative finance one. For the capital raising and all that, that's under shop. So it's $395. That's a freaking steal for how powerful this guy is. And it's this one, right? You can underwrite with various different acquisition strategies, and you can, for me, the most important is being able to identify very quickly, does this, no, Ian, I don't do any construction, brother. I'm sorry. I don't, it's way less. So Ian asked, any advice for construction financing? Not for me, because typically it's much more traditional, or, well, I guess I'll just say no, it's just not what I focus on. I prefer assets that I know I can rent out for more than it costs me each month. That's what I focus on. Not development, not any of that stuff. Not construction. I do some fix and flips, only very big fix and flips that generate over 6 figures in one sale. Because there's just a lot of margin for error. That's primarily why. And I can raise capital. That's, you know, it gives me a competitive advantage. Okay, so private money lender. Let's talk private money partner now real quickly. As I mentioned, private money partner, they're bringing in in this example, they are bringing in $67,000. So your entry is $0. Their private money partner is bringing in the $67,000. They're covering all the entry costs. You, as the one who has the deal and will manage the deal, are going to keep the majority of the ownership. And really, you can do however you want. You can go 50-50, which is pretty normal for when you're starting out. You split 50% to the capital partner, 50% to the other partner. In my opinion, the deal is one job, operating is one job, and the capital is one job. So it's split into, each of those are essentially a third. And that's how we do it in our business model, roughly. And then your cash flow doesn't have to be exactly the same percentage as your ownership. And let me show you why. So if you were to give 30% ownership at 30% cash flow, your private money partner is going to generate, their total benefits are $7,297.70 between debt paid, cash flow, debt paid down, appreciation, and the tax benefits, assuming they're in the 28% tax bracket and they can actually leverage those benefits. But the cash on cash return is only 3.7%. So what we do is we offer a preferred return. So if someone is our private money partner, we'll give them the first 5%, or we'll give them all of the cash flow until they get at least a 5% return. And then we'll split the remainder based on our ownership benefits. Or another thing you can do, and that's kind of based on what they do in the multifamily space, what you can do is just give them a higher percentage of your cash flow if you choose to, because I like to get my private money partners somewhere around a 6 to 8% cash on cash return. right? Because that cash on cash return is based on the cash flow. And if I'm giving them much more than 8%, I could have just raised the money through a private money lender and just gave them the money instead of my private money partner, and I wouldn't have to have given up ownership rights. So what you could do is increase your cash flow to, let's say, in this instance, 50%, get you that 6%. Let's say you give them 60% to incentivize them. You say, hey, we're buying this asset together. You're getting 30% ownership, but you're also getting 60% cash flow. So your overall return, your cash on cash is approximately 7.4%. And your total return on investment is 14.6%, right? So hopefully I don't know if I'm saying this very clear, but your private money partner is going to own the asset, which means they get ownership benefits and they get cash flow, but the percentage of cash flow they get doesn't have to be the same amount as their ownership benefit, right? And if you, as the one that's raising the capital, you need to make it enticing for your partners, and they're probably going to want a solid return on their investment. And for most people, if you're going to pay a private money lender 10 or 12%, you can pay your private money partner a lower percentage, but you still need to get them a solid enough return. And I like to give them at least what they can get in a high yield savings account. So not only are they making more than they can get in a high yield savings account, but they're also getting these other benefits of ownership. Scott, is there a reason you go with a private money partner? Seems like way more involved than just straight debt. 100%. It is way more involved than straight debt. However, sometimes it's hard to raise, the last 3 deals that we've done are $120,000 capital raise, and the other two are $140,000 and $142,000. Sometimes it's hard to raise a private money lender at that amount, or it'll kill your deal at a 12% PML, but it won't with a private money partner, just giving them a percentage of the cash flow. So that's one reason. The other reason is, I said you can refinance one lender with another lender, right? However, once again, it's kind of hard to raise $100,000+ from a private money lender. So having a private money partner where I don't have to worry about that exit really helps. Yes, it's more work because now I have to split all these benefits with them and we have to own this asset together, all that stuff. However, at least I don't have to worry about what am I going to do in 1 year to refinance them out. I've got, all my private money partners understand we're holding this asset for at least 5 years. And then we reevaluate. Do we want to sell it, cash out, refinance it, keep everything as is? What do we want to do at that 5-year mark? So I don't have to worry about getting them their money back in 12 months or 24 months, if that makes sense. Feel free to unmute yourself, guys, if you have any questions about any of this, because I kind of gave you the high level overview, the difference between a private money lender, private money partner, when I use one versus the other, or why are some reasons I'd use a private money partner versus private money lender. And some private money lenders don't feel very secure when there is a sub-2 loan, seller finance loan, and now they're in third position behind all that. So maybe a private money partner, that also mitigates that concern. And if you were to have $100,000 capital raise, but you only have private money lenders that have $50,000, if you were to have 2 private money lenders, well, now one of them is a higher position than the other, and that gets a little messy too. So are you going to offer one of them a higher interest rate return, or are they just going to be cool with it? If it's 2 private money partners, it doesn't really matter because you can just split their ownership 20%, 20% or whatever. In this instance, 15%, 15%, same concept. Yep, go for it.
Cool.
Just let's go. Yep.
Cool. Question. Is there ever a situation where a private money partner wants to change the ownership and cash flow percentages after the 1-year mark?
A private money partner wants to change the terms. Well, it wouldn't work that way. In our joint venture agreements, it outlines, these are the terms of the deal. What we do offer is if a private money partner wants to exit early, they can. We'll cash them out, but they're not going to get the full return that they were going to get. They don't get any of the ownership benefits, and they actually lose a portion of the money that they contributed early on because now we have to refinance them out. However, if they wait at least the 5 years, not only do they get all the returns they've had, plus they get their original contribution back as well when we sell or refinance the property, right? But if they were to want to exit early, I don't ever want to force someone to stay in a deal that they can no longer do. However, because it puts us in quite a position, a difficult situation, they don't get the full entry, maybe instead of 67, they'll get 60,000 of that back. But changing the terms, not really. I mean, could we discuss it potentially? But that's the one risk that's the risk for private money partners. Private money lender is going to get, that's what they get, a fixed interest rate return. This guy who gives me $67,000 is expecting 12% return, $670 a month of interest. Well, a private money partner, you're saying, hey, these are the returns that we project. But if you've ever owned real estate, right, not every month is just this perfect cookie cutter. Not every month is the same. So everyone only makes money in the private money partnership when the property makes money. If it's not making money, no one's making money. Does that make sense? Because their risk is that the property's not performing. Whereas a private money lender theoretically is secured to get that fixed interest rate return. Right? Where a private money partner is depending on the success of the property itself. Did I answer your question or not really?
Yeah.
You don't really change terms early, I guess. You don't really change it once you agree to them. Could you have that discussion? Sure. But you go into it with the understanding of that risk, that the property, that's why it's so important to understand how to analyze deals and make sure that the property can cash flow what you anticipate it to cash flow for you. And that's why it's so important to, analyze deals and then work with operators that have proven that if you're lending money to someone who says they're going to short-term rent and it's the first time and they don't know how to do it, well, just understand that there's risk involved with that, right? That's why it's easier for me to raise capital or Rob to raise capital than someone who's on their first deal, because we have the proven record of being able to buy and hold investments, right? And just understand that that's just the risk, or not the risk, that's just the way it goes. And then eventually you'll be on the better side when you have 2, 3, 4, 5 deals, or of them, whatever, you'll be the beneficiary of that system as well, right? It's like anything. You hire the person for the job that has the experience. Same with lending. You lend money to people that have the experience. That's why private money partnerships are also an easier way to raise capital, especially starting out, because you can be more flexible and give them more of the ownership or whatever. But now at that point, you've bought a deal and you have raised capital for it. At the same time as you can use private money partners, another great way for people to start investing and get their first deal is to be a private money partner. And we offer those opportunities. For example, we've offered 3 this month where we're raising capital on deals for private money partners who want to jointly own with us. That is a great way to enter your first deal, learn a ton in the meanwhile without having to know everything. And then at that point you say, hey, I own assets. There was capital raised during, for that asset, even though it's your capital. You can leverage that story for your next deal. And now you have the experience of ownership, where 0 to 1 is very hard. So that's why it's ideal to have your own money to buy your own deal. But if you're trying to buy your first deal, even that can be hard, where you can just go in as a private money partner on someone else's deal, but then gain that experience and that ownership for your next investment. Cool. Frank and Gina.
Yeah, thank you.
Sure.
So I'm kind of guessing. So again, the PMP sounds really cool. But the one thing, so I guess would incentivize us to give a higher percent cash flow is to try to partner with someone and so forth. But what is the benefit for being like the owner? So after 5 years, I guess you're looking to make more money with a refi. Refi, because I guess you're giving like all the cash flow away. They get more of a cash flow. So like, what's the positive benefit for giving away so much of the cash flow to incentivize someone to like be your private money partner?
Right.
And maybe in 5 years later, you make out on so they're making up in the cash flow, but you make it up on a refinance. Is that how it kind of works?
Kind of. So for me, that's why I prefer a preferred return. So it's like you get 100% of the cash flow until you get this return. So 5% at minimum for me. And then it splits based on ownership. That's a better way to do it. What we've done historically as well is, hey, you get 60% of the cash flow until you have the equivalent of cash flow that you've generated over that time period that meets your entry cost. Once you get $67,000 of cash flow, it might take a while, but once you get that, then it goes back to our ownership. Or if you do refinance, depending on how you structure it, when you refinance, that can be your exit from that private money partnership and you solely own the property. We don't do that. when we refinance, we keep our partners on there, but once they get that equivalent of their money back that they contributed, then then the cash flow split is based on ownership as well. Does that make sense?
Yeah.
So yes, you're going to get the majority of the ownership benefits, which for me is very great, right? I'm telling you how I raise money and what works for me. I don't live off the cash flow of my buy and hold business now. The last $15 million of real estate, I don't touch any of that cash flow. All of that is reinvested to continue growing my business, continue paying back my lenders, and continue hiring great team members that help us scale. But I also have a separate cash flow and portfolio that I generated before all this. I have various other income streams. All that, I understand my business partner and I are in a fortunate position because we don't need to live off the cash flow of our properties. So we delay cash flow benefits for the sake of a ton of ownership benefits, which will really generate that wealth. They say cash flow makes you rich, like equity makes you wealthy, right? So we're playing that wealthy game because we already have sufficient cash flow. Maybe it's not the greatest place for someone to start. So building that cash flowing basis could be a great way, but also understanding the waterfall nature. I don't know if you guys are familiar with the term waterfall, but my CFO and I talk about it a lot. We diagram it out essentially. That's not right. We plan it out, and at a certain point, although they're going to get 60% in this instance of the cash flow, well, after a while, once we pay them back their entry costs, then we're going to get the majority of the cash flow. So understanding that'll happen, it'll just take time. Or for example, the private money lender, yeah, you're starting off with $18 a month of cash flow, but you're getting all the other ownership benefits and you're putting money aside for reserves, right? It's not $18, no money for reserves, $18 for reserves, and you already got all this stuff done, right? You paid down the down payment, whatever, all these acquisition, assignment fees, whatever, all these things were paid off, and you had some reserves set aside. And then the next time, yeah, you're only getting $18.46. What was that the first time? $670, I think. So you're getting 600. No, this is the monthly payment, whatever, $18. And then the next year you're getting $130, but maybe you take the excess of that. Maybe you're able to pay down $7,000 of that first go around. So now you're making $188. And the next time, maybe it's only 10%, but you take this $200 that you made a month. Well, that's not even genuine, but you take that $200 and you pay this down. So another $2,400. So you're whittling away that loan and increasing your cash flow over time. So it's playing that like longer game instead of urgently needing cash flow right away. If you need cash flow, go and buy in cheaper areas and use your own money to maximize cash flow. That's the way to do it.
Yeah.
If you have the ability to play the longer game and really generate that long-term wealth, it's going to come from being very scalable in your business model, which means leveraging other people's money, even though it's going to cost you something. It's going to cost you a lot of cash flow in the meanwhile. It just, what game are you playing? It took me 27 rentals and $8,000+ of cash flow before I felt comfortable playing that wealth game. Just depends on everyone else,
So I guess so one, you need a fancy lawyer to write all this up. With all the
kind of.
Yeah. And then I guess
mean,
like the
when you use a title
benefits-
company, you kind of use similar documents each time. But if you're using a private money lender, you have the rough promissory note, and your title company will actually create the documents for you.
Okay, nice.
So a title company will create that. For private money partnership, it's different. Whether you create an LLC that you guys are joint owners of, which is something we have done historically. If we're going to buy a property with a private money partner, we'll create an LLC and we'll both be owners of that LLC. Everything's written out in the operating agreement. Or now what we do is we create an LLC for a state, and instead of splitting that LLC with our private money partner, because we're buying so many deals with so many people, it's really tough to create an LLC for every single property with every single person, every single market. So what we do is we have that LLC that owns the asset, and then we have joint venture agreements, which are between ourselves and our partner. So it's secured through a joint venture agreement, which is then recorded through it's not recorded, but there's a resolution on that LLC highlighting that, hey, we acquired this property. Here's the JV agreement for how we bought it.
Nice, thank you.
So yes, You will need a fancy attorney at some point to get you the stuff, but a lot of these documents are fairly standardized. In my opinion, the best way to start raising capital is to first lend capital, because then you're learning from someone else. But don't lend your money willy-nilly, right? I am of the mindset, I would rather make less return by minimizing my risk, right? So people can make 30, 40, 50+% return, but understand the higher the return, typically the higher risk. I am more of the mindset that I'd rather get less return, but really minimize my risk to lose anything. You can never eliminate your risk, but I would minimize my risk, which means working with people who are more experienced, and maybe they'll pay me less return, but at least my money is more secure through someone who knows what they're doing. And the reason for lending money for most people, especially in this community, isn't just to get return on your money. It's to learn, right? Learn, take ownership, that kind of stuff. That's what I would recommend. If you're going to lend money to learn, make sure you're lending money to someone you can actually learn from doing the things that you want to do. No point in just lending money just for the sake of it, unless you have a surplus. For example, I just lend money because I want my money to be put to work. And if I don't have great real estate investment opportunities to lend the money, I just put it in like the S&P 500 or passive index funds, because my money is always working for me, whether it's in passive index funds or better returns through real estate investing. All right, let's keep them going. Sujita, you are next.
So Michael, you said that that the money should be working for you, right? And like myself, like we have like saved money to invest, but like your idea that you said you should find a private lender and invest that money, that sounds good. Again, even if you have money, like if we find a private lender, I know, and I'm very new to this whole course, so I'm learning here, but how do you find the property? I know Rob has different videos and that to look for that property. How do you find that experienced partner? Like if we have to find it, what do you have to look
for? 4 different
partner?
things.
Yeah.
Are you asking how do you find the lender, or how do you find the property, or?
How do you find the perfect partner? Like if you have to go with a partnership where you know your money will not be just like.
So it's kind of annoying because I hate social media. Personally, I'm not much of a consumer. I'm forcing myself to be a producer, however, or like a creator or whatever. But social media is, in a sense, your like online resume, your digital resume. So people who are actually doing the things that they say that they're doing is a great starting place, right? I don't ever lend money personally to people who have never done a deal before, because like I said, I don't like to lose my money. I'd rather work with a proven operator, someone who's done the thing. So going to real estate meetups and your local RIA, real estate investment association meetings, connecting with people who have already done the thing. People like, I'm going to plug myself, people like me who come in and educate on these topics are probably a better person to lend to, but they still have to prove themselves to you. So how do they prove themselves? Understanding, okay, how many properties do you own? Where do you own them? What does your business look like? Can I talk to other lenders that you have worked with? That's the number one. If someone's not willing to share with you the types of deals they bought, how they're performing, and how are their lenders, like if they're not willing to connect you to their lenders, that's not a great sign. Or if they've just done this thing and they just started and they've maybe, even if they raised $1 million, but they haven't taken a single deal full cycle where they've had to pay off a lender, well, that doesn't mean a lot. Like, it's one thing to raise money, it's another thing to actually perform and pay back your lender. So, I mean, talking to people, going to where real estate investors are, whether that's physically or digitally, that's going to be the best ways to do it. Does that make sense?
Oh, thank you.
Cool. And if you have a follow-up question, I'd be happy to answer it. Otherwise, let's go with Scott.
Hey, thanks, Michael. Thanks for answering all my questions. So going back to PMP versus private money lender, it sounds like as the deal size gets bigger, you're going to tend to have to go with the partnership much more. So like if you're looking at your deals 1 to 2 million or up, is it always private money partner at that point? Or are you just not going to get private money lenders at that size?
It's less about the property size or the property price, more about your entry costs. I've bought $2 million properties. Well, let's see. Let's look at this beautiful property. Gosh, why are none of my shortcuts working? Let me see if I can. There it is. My text replacement isn't working in my URL. So I bought this $2 million property with less than 100K. So I raised the money through a private money lender. How? Because I'm freaking skilled as shiz when it comes to negotiating and identifying motivations and really focusing on what does the seller need over what do they want. This guy wanted a lot more money up front, but what he needed was monthly payments that helped him move on, as well as someone to take over this property before he lost it to foreclosure. So all I need to do is pay back any debts that he owed on it and made sure that the debts moving forward were paid for and that he was making some money on the side. So that's how I was able to get this great one with a lot less money down, because everyone wants everything, but your job is to negotiate based on what do they need primarily. So that's one thing. So it doesn't really matter. And I've had, let's see, what's the biggest small? I've had plenty of properties around the $500,000, $600,000, $800,000 that I've had to raise more money for than this deal, for example. And this one costs a lot more. So it's really the entry cost more than anything else. And I would say, yeah, anything over $100,000 becomes really tricky with a private money lender, just because of the fact that $100,000, well, it's $12,000 a year, but $12,000 a year of interest. So you're probably gonna have to generate enough money to pay $1,000 of interest to someone else every single month. It just becomes unsustainable, right? Sometimes it makes a lot of sense, but usually it doesn't. So I will do everything to minimize my entry cost, which means the more I can get the seller to finance, the better. Or the more I can negotiate and reduce my upfront costs, the better. But at a certain point, it becomes not sustainable because very few properties are out there just generating you $1,000 a month of money to just pay someone else, right? So that's a big factor. Does that answer that, or would you like to expand?
No, I think that's right. It sounds like it's just a relationship game for the most part. As you get into the more advanced properties, it's all doable, it's all possible, but you got to be an expert with both the seller and then an expert with your network to be able to find people who can fund what you're bringing.
Right. And some people are going to have private money lenders. You know, someone's going to have, I mean, I'm a veteran and I'm a real estate investor. So my network are real estate investors and military. You know, if my network was people like Akash, you know, if I had doctors and all that I know, well, it's a very different thing and how much capital you can raise per transaction. I mean, even my guys in San Diego who have a lot of money, they're really not lending that money. At a certain point, you have so much money, you're not just lending it for 10, 12% return. You want other things like ownership in the story. Like they love to walk through our properties and be like, oh yeah, look at these houses that I own. And we bought this one 0%, you know, interest rate or whatever. So it really depends. Unfortunately, my guys really love the story or have lower amounts, like 100,000 or less, unless they're getting ownership from that. And I'm cool with giving up ownership. Some people want to keep the whole grape to themselves. I would rather split a watermelon, right? I'd rather get more and split it than just get smaller thing, but entirely myself. If that makes sense. And that's the way I've done real estate for the last 3 years. And it's way more fun for me personally. But I also was the sole beneficiary of the 27 rentals I did myself before that I get to live off of, as well as solid W-2 income on top of that. So I can't tell you what does and doesn't work for everyone. It's just a position I'm in right now where I can do this. So understanding the different periods of investing is very important too. You know, I always tell everyone, focus on cash flow first when building your base, and then at least cover your minimum expenses, especially if you're looking to quit a job. I'm the last person to tell you to quit your job. I'm not saying you shouldn't ever quit it, but having to live off the money you're generating from buying and holding real estate, some people can do it. It's very stressful. It's very volatile. And there just isn't a ton of cash flow, especially early on. That's why short-term rentals, renting by the room or pad split our sober living homes, our midterm rental homes, they generate more cash flow, but they also are more volatile than, let's say, a long-term rental. So I don't advise, but like I said, I'm risk averse. Ironically enough, I own over $15 million of real estate, financed primarily through other people, whether it's sellers, private money lenders, private money partners, and or just traditional debt, you know, it's still financed extremely high. And I'm still fairly risk averse. I'm very risk averse when it comes to potentially losing everything because I jumped ship too early. So I always recommend people keep their job longer than they think they need to. And yeah, but that's me personally. I mean, everyone's got their own risk tolerance. All right, what else do we got? No more questions. All right, so is it Didi? Is that your first name? I don't know what your name is because it's all combined.
Oh, it's DDA, but yeah, everybody calls me
DDA?
DD.
Perfect, beautiful. To increase cash flow, buy in the cheaper areas. How would you invest when you want to focus on increasing equity? So Sarah, thank you. Higher equity on lesser, I'm reading what you said and then I'll add my input. Higher equity on lesser expensive home equals higher cash flow because you are not paying off P&I as much. Higher equity on a lesser expensive home equals higher cash flow. A strong performing 500K property, 20% down will cash flow much higher. Yeah, that's true. That's one way to increase your cash flow is to put more money down. But I think what you're more asking is you can think of, and it's not 100%, but you can think of cash flow and appreciation or like the equity play on opposite ends of the spectrum. And equity comes from two things. Equity comes from the property appreciating in value, right? And it comes from paying down the debt. So what Sarah highlighted is you can pay down more of the debt to increase your cash flow, or you just hold your property and just keep making payments over longer periods of time. Amortization schedule will pay down your debt faster and faster. But if you think of cash flow on one end of the spectrum for investing and appreciation on the other, which the majority of equity is going to come from that long-term appreciation, properties that cash flow really well usually do not appreciate very well. Properties that appreciate very well do not cash flow very well. For example, think of a Kentucky property is going to cash flow much better, but will not appreciate as much as a San Diego property, which will cash flow much worse, if not even be negative, will appreciate tremendously well. Is that 100% accurate? Well, it's pretty close. I would think of it from that perspective. There's certain markets that increase in value a lot more than other markets. But typically, if it's going to increase substantially in value, it's probably not the best cash flowing asset. You won't know unless you analyze the deal individually. But as a rule of thumb, a property in San Diego is going to appreciate much better, but have much less cash flow than, for example, some of my properties in Alaska, which cash flow very well, but their appreciation barely meets inflation. If that makes sense. They're just two different types of markets.
Gotcha. Thank you. Thank you.
And properties that appreciate better are like those Class A neighborhood, really nice, really, bigger properties. Whereas those are appreciate better. Whereas your best cash flowing assets are honestly your smaller 2-bedroom homes in like lower cost of living areas where you can buy them for 50, 60. I was talking to someone earlier, Cincinnati, Ohio. You can buy a duplex for $100,000 that generates, $2,000 a month of income. Well, in San Diego, for $2,000 a month of income, you're going to need to buy at least closer to $1 million property, right? So the debt is higher, so you have to pay much more in expenses. Orlando is a good example for that. Great cash flow, but not going to appreciate as much. Sure. I mean, I would say yes, but then there's markets that are more in the middle. For example, like some of that's why I love my Georgia's, North Carolina, South Carolina deals, because they're kind of in the middle. You're getting both cash flow and appreciation, but not as much of either as you could in other markets. I really have my portfolio was fully built on strictly cash flow assets until I got the $8,000 a month of cash flow. And then I started buying a few properties in San Diego, which was my local market at that time, because that's a longer term wealth play. And now the majority of my assets are right in the middle between appreciation and cash flow. It's kind of in the middle between the two. And for every one deal I buy in San Diego, I'm buying 10 plus others in more cash flowing markets, you know, because you need that cash flow. Like, it doesn't matter how well a property appreciates if you cannot afford to keep it, I guess. And the only way to keep a property is to have it generate you more income than your expenses, unless you are subsidizing that property with other income streams. Right? Sujita, go for it.
So you said for private money, find a private money lender who will lend on interest of 12%, right? So in that case, we can also like take a HELOC on the house, which is like say at 9% and use that money. Is that a good way to do the investment, or is it a bad way to do the investment?
That's a phenomenal way to do the investment. It's not scalable because you only have so much money in your HELOC, but it's a great way to invest the money you have in your HELOC because it's cheaper than what you can get from a private money lender. Does that make sense? It's a great use of those funds, but it's also not scalable because you only have so much equity in your HELOC that you can tap into.
Okay. Yes,
Right?
yes, it does make that. Yeah, I just wanted to make sure that that makes sense, because if I'm paying only 9% on the HELOC and is versus 12% given to the private money lender, that still makes sense. And with the amount that you showed, the calculation that you showed, that will still be getting more cash flow. Say on the 60,000 is the entry, and if we're doing 9% there, then I think so the cash flow is going to be even more. And you know that money is like divided, let's say in 10 years, 20, 30 years that you'll be paying it back along with the interest as well as the capital, and you can circulate that money. And that should be a safe way to do it, right?
Yeah, when you say circulate that money, I mean, you still have to pay it back, be able to use it again. The nice thing about private money lenders, like for your HELOC, it's great because you're gonna save. If it's 12%, you're gonna cash flow $88. If it's 9%, you're gonna cash flow $238. However, that HELOC money is limited to how much you can get, right? Once you use it, it's kind of in there until you can pay it back. Whereas if you have multiple private money lenders, you kind of have an unlimited amount of deals that you can buy, even if you're paying higher percent interest. So it just depends on what's best for you. It's a great way to start investing, especially and tap out on the number of deals that you can buy using your own money, and then start raising capital to be able to buy more properties, if that makes sense. The reason for private money lenders isn't because you're going to get more cash flow. You're going to get way less cash flow. You're going to get more cash flow than you had before, right? Which was zero, we'll say. But you're going to lose a lot of your cash flow to your private money lender because you're paying them. But the freedom of having a private money lender is you can get multiple private money lenders for multiple different deals. So you have an unlimited amount of capital to buy real estate investments, right? You're exchanging cash flow for the ability to buy more opportunities. If that makes sense.
Yes, it does make sense. But again, like Michael, you're saying if you're doing your first property, it is very hard to find a private money lender. So say if you want to get into this and get that experience. So my question to you was,
That's a great way to do it.
Good way to do
To
start?
use your HELOC.
Okay.
To use your HELOC, your savings, whatever, or private money partnerships, whatever, to get into that deal. Now, your question next should be, do you want to be the one who finds the deal, uses the capital, and manages it? Or do you want to come in as a private money partner to someone else, and you're going to get some of the ownership benefits by being the capital partner, and you're going to learn from them? That's kind of your next question, because it sounds like you have the capital piece handled. I think a lot of you guys are learning how to self-manage your assets. So it may make more sense, instead of lending that money, to instead just buy the asset and learn from there. Does that make sense?
So now if you're saying if I have the capital, right, what is the best approach to go then? Be a private money lender and a partner to somebody to learn the approach, like definitely with zero knowledge.
I mean, there's value in both. If you're a private money partner to someone who's very experienced doing the thing that you want to be doing, that's great, because you're basically making money and learning. It's basically you're getting a return on your money, and you're kind of getting a mentorship right there to learn from them and ask them questions about whatever. But obviously, if you're the one to buy the property, you're going to learn a lot more by doing it all yourself. It's just, are you going to learn how to do it right or wrong? I don't know. You're gonna have to figure it out. Like, that's kind of the idea. I'm of the camp where I am more than happy to pay for mentorship and training that I believe I need at that time. For example, I've learned how to raise capital from others. I've learned how to, I mean, I was doing creative finance, but I learned the basics of seller financing initially. I continued improving myself until I joined Sub 2 to get really great at creative finance. So there's, you know, I'm of the camp of it's very much worth paying to learn, especially if you're paying and you actually also own the asset. So you're kind of getting a 2-for-1 as a private money partner. You are paying to own that asset with them, but you're also paying to learn in a sense. For example, one of the things that we teach all of our private money partners, we want them to continue to have money to lend to us or to build their own portfolio. So we teach them at a high level is how to raise their own capital so that either they can continue buying real estate, raising the capital to buy these opportunities as a private money partner, or they can use that money to then buy their own investments. That's just something that we add, but you know, not everyone does something like that. We just do that because we see the mutual benefit of teaching everyone how to raise capital. Because everyone, if you think of everyone as like there's me at the top, right? But if I teach 5 people how to raise, and I know, let's say 5 people, I can raise capital for 5 people, or I could teach those 5 people how to raise capital, and they each know 5 people, and it continues trickling down. Like there's all these people now that can potentially work together to raise capital for deals, as opposed to just raising the capital from people. I'm also teaching, so they could also raise capital, whether they invest it with me for themselves, whatever, but at least they have that skill set and they're, you know, have more access to capital than I ever could individually.
So Michael, are you a guest speaker here, or like, do you have your own individual? Because we have definitely, like you said, like learn and pay for it. So we have paid for this course here with Rob, right? So if we have to do learn from you, or like, you know, be a partner at your firm, how does that
I'm
work?
not pushing anything paid or anything. What I will show you guys is my free school community called Wealth Through Real Estate, where I focus I'm going to drop the link in here. I focus primarily on deal analysis and underwriting, because I think whether you're a buyer, a lender, wholesaler, connector, whatever you are, it is imperative to understand how to analyze a deal. Like that is the most foundational thing. I think people get overzealous or overeager and start investing in very bad deals because they just want to do something. But it's way worse to invest in a bad deal than it is to do nothing at all. You're better off more often than not doing nothing than investing in a bad investment. And I've been teaching deal analysis since 2020. And the thing I used to always state and still do is that 95+% of properties that are for sale are not good investments. They're just properties for sale for someone to live in. They're not investment properties. So you need to be able to differentiate what is good and what is bad so you can quickly filter out what is bad. And that's what we talk about. I mean, in the classroom, I have how to analyze real estate investments traditionally, whole series on that. How to analyze investments creatively, whole series on that with a seller financing subject to seller finance, and then live underwriting. So when we do our Q&As and all that is linked in there as well. For example, we talked about a strategy that I really like. Instead of wholesaling, it's something called bird dogging, where you are essentially finding a buyer who is an actual buyer, and you're helping find deals that are exactly within their buy box. If you find them those deals, you get paid for that. And that's a great way to develop your skills, to analyze great deals, to see what buyers want. And even if you go further and raise the capital for that deal, you get even more money, or you can make even more money. Do row-built students get access? Tara, I'm not sure what you're referring to. I'm sorry. To the school? Yes. Asking from a lender's perspective, since I've invested for months, can one start as a PML and promote to a PMP based on the relationship? Yes. So not often, we have done it twice, where when our private money lender balloon is up, we're always going to give first choice. So Raj's question was asking from a lender's perspective, since I haven't invested for short-term rentals yet, can one start as a private money lender and then promote to a private money partner based on the relationship with the partner? Yes. So at least the way that we do it is, if we have a private money lender and their balloon is up, let's say January 1st, we're going to say, hey, lender, few options for you. Your balloon is coming up. We're more than happy to pay you back your interest, or pay you back your principal and your interest. However, if you want to extend your loan, we're welcome to do it. Normally we would offer a 10% return this go around. We'll keep you at 12% if you want to extend it, but if we can do it for a longer period of time, or we can convert you to a private money partner at these terms. So instead of just being a lender, now you can own the asset with us. We do both those. We give our lender the option first before we bring in someone else to replace them, if that makes sense. That's the way that we do it. I can't speak for everyone else, but that's the way that we do it. We always try to work with our private money lender first. So Tara, this is totally separate from Rob. This is totally separate from whatever you guys got going on. I'm just sharing a free school community that I have. Oh man. All right. Well, it looks like some of you found it. Some of this is already outdated. We're buying millions of dollars of assets each month at this point because we've mastered capital raising, deal analysis, and I've spent the last 6+ months going all in on investing in my business to create the best operations there are. Because in my opinion, it's very easy to raise money and buy deals. The hard part is to execute a pro forma. If you're analyzing something, can you actually execute that? And ensuring your operations are successful to scale with your business. So I've brought on a CFO who helps us with so much of what we do. I brought on we've hired on our chief operating officer, which instrumental. My business partner primarily focuses on deals and I focus on capital raising, but we both overlap in what we do. Underneath our COO, we have an operations manager and an asset manager, and we have in-house property management company, and we have in-house transaction coordination company. Plus, we have a bookkeeper to help our CFO out, because they're not going to sit there on the monotonous stuff. That is all extremely important. And that is what we've done to take our business to the next level so it continues to scale. So what we're talking about with you guys is starting your business first and foremost and just learning the fundamentals. And then eventually, depending on what you want to do you want a business that owns 50, 100+ properties and you're buying multiple properties a month and raising millions of dollars a month? Or do you want to just buy 5 to 10 properties and live off the cash flow of that? It's ultimately dependent on you. I show kind of my journey as well as what I recommend, and people can stop at any point of that. Whether they want to just buy and hold a few properties, they want to create a full business out of this, it's up to you. And that's what this free community is primarily geared towards. But the foundation of everything is deal analysis and underwriting. I have more stuff coming out in the very near future, basically hand-holding. Very few people. I don't like to do anything in large group settings except for training Zooms like this. Very few people I will handhold and show them exactly how to buy real estate the way that I do, primarily leveraging other wholesalers and investors and renegotiating their deals to make them better. If you guys have been seeing the deals that come into just in general from wholesalers, they're not great usually. So you need to have the skill set to understand, can you renegotiate that deal to make it better or not? That's the foundation. That's the majority of my deals come from that now. Or joint venturing with people where they have a motivated seller, but they don't know what to do. I come in and I close the deal, negotiate the terms, and then we decide to buy it at that point. So that's where a lot of my deal flow comes from. So understanding that foundationally for deal flow, and then how to raise the capital, what documents to use, all this stuff, marrying everything together so they can create their own buy and hold business, leveraging other people's money, and then lending their own money to others, just the way that I do it. So I'm going to do that with a small handful of people where I'm going to show them how to recreate that exact business model, but I don't want to do too many people at once for that. I have no timeline on that, no timetable, whatever, but it's basically showing people how to recreate my business model and handholding them through my organizational chart, my standard operating procedures, my exact business model, how we do everything, my tools, my systems, so they can do the exact same thing. But that's really if you want to grow a pretty large portfolio, leveraging other people's money, right? It's more of that unique type of audience. Cool. All right, I'm gonna take that as cool. All right, y'all. Last second. Any more questions before I go hang out with my baby and my wife? Angel, thank you, brother. Thank you for joining. All right, y'all. If you guys ever need anything, let's highlight here. Number one place. I mean, if you're not following me on Instagram yet, then you're missing out because you are not seeing enough photos of my baby. And I'm sorry for you because she is freaking cute and just turned 2 months yesterday. Instagram, I have a YouTube channel. Let me drop the link in here where I go over more deal analysis and things like that. And then I have my school community. Like I said, it's just free. There's trainings. My main goal, if anything else, is just to ensure people are better at analyzing and underwriting deals so they don't make bad investments. Like I said, I'd rather have someone make no investment. Shit, I'm not saying no investment. Put your money in passive index funds and get 10% annualized. I mean, it's not inflation adjusted, but 10% return just in the stock market over a long enough period of time. That's great. That's better than doing nothing. But I'd rather have people do that or do nothing than buy the bad investment, because not only are you now losing money, you're now losing your mental space is being wasted on a bad opportunity, and you're just trying to stay afloat on a bad investment. So my goal is to ensure no one makes any bad investments. Can you plan and predict for everything? No, hell no. You can't anticipate everything, but you can do as much analysis and due diligence up front to at least minimize your risk. And that's my overall goal, just to make sure there's a lot less people who are making bad investments. And eventually you own really cool properties like this one and whatever else. I mean, we got a bunch, but yeah. Cool, guys. Have a great night. Multiple ways to connect with me. I better get like 10 new followers after this. We'll see. Just kidding. Have a good night, y'all.
Cool. Thanks, Mike.
Thank
Bye.
you.
Thanks, Mike.